let's go ahead and go through the solution to the intercompany sale of the depreciable asset. And again, first order of business, of course, is to get some fixed numbers in here. Okay. Again, what have we got? We have Big owns 65% of Little's voting stock. On January 1st, 2020, Little sells equipment to Big for $98. The asset had originally been purchased on January 1st, 16, so 4 years earlier, for $150, and was being depreciated straight line over 20 years. The asset's expected salvage value was $20. Assume a separate accumulated depreciation account is used, and assume that Big uses the full equity method. And basically what you need are the elimination entries from 2020 through 2022. First order of business is to determine the accumulated depreciation and therefore the book value and therefore the gain or loss on sale. The annual depreciation, again, we've got nice simple straight line depreciation, cost minus salvage divided by useful life. So $6.5 per year for annual depreciation. Accumulated depreciation, again, it's been depreciated for 2016, 17, 18, and 19, so we have 4 years of accumulated depreciation at $6.5 per year, or $26. So the book value, again, book value is cost less accumulated depreciation. Cost is $150. Accumulated depreciation, we just figured that out. For a book value, cost minus accumulated depreciation. Okay, so there's our book value. This thing was sold for, let's see, selling price 98. And so it had a book value of 124, it was sold for 98, so obviously we're going to have a loss on sale of $26. Again, clearly if it's sold for less than book value, that implies a loss. Okay, so what do we have to do in 2020, the year of sale? Basically, we need to eliminate the loss on sale, and we have to restore the asset to make it look as though it had not been sold. So first, a loss on sale. Loss on sale is a debit, so to eliminate that, we're going to credit loss on sale. Now, when the asset was sold, the seller, Little, would have removed their accumulated depreciations. We need to reinstate that accumulated depreciation. Accumulated depreciation is a credit balance account. They took it off the balance sheet when they sold the asset. We need to put it back on. So we've got $52 on the credit side. So that means that on the debit side, we must also have $52. And just to sort of confirm, the equipment is currently on, again, this was an upstream sale, so Big is the current owner of the asset. The equipment is currently on Big's balance sheet at the price they paid for it, $98. The true cost is $150. So what we're doing with this debit of $52 is we're getting that equipment back up to its correct historical cost. Okay, so by doing that, we make it appear as though the sale never happened. We've restored the equipment to its true cost, we've restored the accumulated depreciation to what it should have been, and we got rid of that loss on sale. Now we need to go ahead and ask ourselves, do we need to recognize some of that gain? Again, there's this some of that loss. We've got this $26 loss, and that's going to be recognized over the remaining life of this asset by adjusting depreciation expense. Now this asset had an expected life of 20 years. 4 of those years have elapsed. So we're going to recognize that $26 over the remaining life of 16 years, a rate of 1.625 per year. And again, we're going to recognize that loss by increasing depreciation expense. So basically, the argument we're making here is that, look, Big company, the new owner of this asset, they bought this asset, on the cheap. They bought it at a discount to its correct book value. So they're not taking enough depreciation expense. We're adjusting the depreciation expense upward to reflect the correct amount. It's not necessary. This is the easier way to make that computation, saying, look, I got a loss. I need to recognize that loss over the remaining life of the asset. If you really wanted to, you could say that Big's reported depreciation, they're taking their cost of what they bought. They bought it for $98. That salvage value still applies. Salvage value up here. And this thing has a 16-year life remaining. So Big's reported depreciation is 4.875. The correct depreciation is that 6.5 figure that we calculated up above, a difference of, believe it or not, 1.625. So what we're doing is we're saying, look, again, easiest way by far as I'm concerned is to think of this in terms of the loss that's being recognized each year. Alternative, just as good, a little bit more time consuming, is to think of this in terms of the depreciation adjustment. Big is reporting depreciation of 4.875. They should be reporting 6.5, so we need to boost their depreciation expense by 1.625. The income to the non-controlling interest, this was an upstream sale, so the non-controlling interest is going to be relevant. They're going to get 35% of Little's adjusted earnings. We start with reported earnings, as always, and we say, okay, this first thing, we put a credit on the income statement for $26. That increases the earnings, right? We're taking away that loss, which increases the income. At the same time, we're also adding $0.625 to the depreciation expense. That's going to reduce earnings. So the income to the non-controlling interest, in this example, $35,008.50. Okay, 2021. Now we think in terms of carrying things forward. First, look at the equipment account. We have a debit to equipment. Nothing else here mentions the word equipment. Basically, we're carrying forward this $52. Next, accumulated depreciation. What have we got? We credited accumulated depreciation for 26. We credited it again for $0.625. Total credits we're carrying forward, $27.625. The remainder is the remaining the remaining unrecognized loss. Again, there was a loss initially of $26. There it is, a $26 loss. We recognized $0.625 of it, and so there's $24.375 remaining, still unrealized. Okay, that's that plug figure that's missing. Now again, here's where our two questions come in. Was this upstream or downstream? This was upstream, which means the non-controlling interest is going to get their share, 35%, of basically that. The parent's share, the other 65% of that 24,375, is, we have our other question, is the parent using the full or the partial equity method? The parent is using the full equity method, which means that the adjustment is going to be an adjustment to the investment in Little account. Okay, so we carry forward the remaining unrecognized gain or loss from the previous year. Then again, we have to update or correct the depreciation expense, recognizing another 1.625 of that loss. 2022, same drill. We gotta stop that. We carry forward the equipment account. First, we debited equipment. Didn't do anything else to affect the equipment account, so we're carrying forward that $52 debit to equipment. The accumulated depreciation account. Again, what did we do? Last year, we credited accumulated depreciation for $27.625, then credited it again for $1.625, so we're carrying forward 29, whatever that is, 29 and a quarter, I think. The difference is the remaining unrecognized or unrealized loss, which we're again going to split 3565 between the non-controlling interest and the parent's investment in little. So the non-controlling shareholders are going to get their share of that net amount. The parent is going to get their share of that net amount. And then again, we say, okay, time to recognize another year's worth of depreciation expense. Okay, and we follow this same pattern over and over. Next year, when we carry this forward to 2023, again, we're going to debit equipment just like we did before, accumulate, and we can just, I'm not going to mess around with that. Yeah, we'll. Let's just go and copy that. So we're getting an special added bonus, 2023. Again, accumulated depreciation, we're carrying forward what we had from last year. 29.25 was last year's amount we carried forward plus what we added. This is going to be the difference being split 65-35 between the parent and the non-controlling interest, and then we do another year's worth of recognition of the loss. Okay, some of you would have had an example with a gain on sale. Others of you had an example with a loss on sale. And for those of you who had a gain on sale, some of them you wrote the equipment up with a debit. Others you wrote the equipment down with a credit. It all just depended sort of on how the random numbers played out for your example.